Well, thank you so much to the conference organizers for including this paper in the program. I am Nishant Vats. This is my first time coming here. I am usually a tropical creature, but I'm going to take my first ski lesson today. Hopefully everything goes fine and less troublesome than this session. So today I'm going to talk about household portfolio and how does deposit insurance threshold household portfolio, and if at all there are any lessons or implications from the perspective of supply of safe assets. This is based on joint work with Nicola, Limodio at Bocconi and Pulak, Ghosh at Bangalore. So before I begin, just to fix ideas, when I use the word safe asset, I want you to think about an asset that is one, liquid, two, retains its value even during systematic crisis or big shocks. So in the words of Dan Gorton and Holmstrom, you can think about the security as security whose valuation is not affected by idiosyncratic information shocks. Or in the words of Bruno Myers-Anikov, you can think of the security as a security which has a non-positive beta. So basically these safe assets have a lot of properties which basically make them like a reliable store of value as well as collateral, and as a result there's a strong demand for these kind of assets in investors' portfolio, and that is evident from the strong convenience yield that these assets often earn. So this has been shown by Krishnamurthy and Wissing Jorgensen in the context of US securities or USG6. So while there's a lot of discussion about the demand, the supply of these safe assets is often limited, and institutional arrangements and government guarantees shape the supply of these safe assets. One such institutional arrangement is deposit insurance. So we know from the seminal work of Diamond Dybvig that banks are inherently prone to this risk or bank risk or bank run risk, and deposit insurance basically makes these deposits almost risk-free. So basically, deposit insurance threshold kind of provides like a limit on the supply of safe asset that is available to household. This is more so the case in emerging economies, where often the only safe assets that households have access to are basically insured deposits. And what I'm going to argue today is that insured deposits is basically going to limit the supply of safe asset. And what do I mean by limit supply of safe asset? Meaning there does not exist a finite price at which you're able to buy an incremental unit of that particular asset. So what we're going to argue today is that this particular supply of safe asset being limited by deposit insurance is actually going to affect household portfolio allocation. And we're going to try and convince you today and argue that basically this is the missing piece of the discussion of the optimal deposit insurance. So whenever we have thought about the optimal deposit insurance, we've always thought about two opposing forces. On the one hand, deposit insurance makes deposits more stable and improves liquidity creation in the economy. And on the other hand, what it does is basically increases risk taking. So these are basically the pros and cons that we have always thought about while thinking about the optimal deposit insurance. What we're going to talk about today is that there's actually a missing piece to this discussion of optimal deposit insurance. That is, how does this deposit insurance threshold affect retail household portfolio allocation? And that will be the key contribution of our paper today, and also like adding on to the seminal work of Davila and Goldstein. I walked too far away. So what we're going to do in this paper, we're going to start with a very simple theoretical framework. We're going to show you that the capital allocation line actually has a kink when the supply of safe asset is limited, and the result of that would be that there will be bunching at the deposit insurance threshold and will have implications for the portfolio allocation of the households. Then we're going to basically go to a very detailed data from India, which is going to allow us to observe deposits, stock holdings, mutual fund holdings, as well as other illiquid, long-term but riskless holdings of around 300,000 depositors over a very high frequency, which is like monthly frequency from like over like 2-3 years. And then we're going to combine this data set with a natural experiment in India that increased deposit insurance threshold by 400%, basically from like around 100,000 rupees to around 500,000 rupees. What do these rupees mean? I will tell it to you in a few moments. Then we're going to basically use these methods that we develop in the theoretical framework to inform our empirical design. So we're going to start by looking at the deposit distribution. Then we're going to basically look at the event study around this particular deposit insurance change. Then we're going to make a comment on like what happens to the portfolio allocation as a result of this event. And lastly, we're going to make some comments on the welfare implications of this for the household from a very partial equilibrium perspective. So this is not a general equilibrium notion of welfare here. And our key results of the paper are going to be that this deposit distribution, as we see consistent with the model, that you will see bunching at the old deposit insurance threshold. And once this deposit insurance threshold does not retain its significance in the sense that deposit insurance threshold is improved, we see that deposits increase, especially deposits increase more so for these individuals who were bunching at the old threshold, which we're going to refer to as the bunchers. Then we're going to show that this actually has implications for the portfolio allocation. Specifically, we show that only very special kind of bunches are the one who respond. That is the bunches who actually trade actively in the stock market or in the mutual fund landscape in India. And we can actually look at their ISIN level stock holdings, and we can actually say what exactly are their liquidity. And what they find is that these bunches had an unmet demand for safety, and they were looking for safety even when the risky gamut of the stock market, which is the state-owned enterprises. So they were over-tilting their portfolio towards stocks of state-owned enterprises, and this liquidation actually had temporary price effects. Lastly, we're going to comment on the welfare effects. We're going to show that this actually has positive welfare effects on individuals, despite even accounting for the moral hazard implications. So our key contribution, as I said, like most of the conversation in the deposit insurance literature, when we think about the deposit insurance threshold, has been around thinking about the liquidity creation implications for deposit insurance, as well as the risk-taking implications for deposit insurance. What we are talking about is like how it can actually affect household portfolio allocation, and that has its own welfare implications and also perhaps inform the deposit insurance threshold literature. So again, we're not trying to say that at the end of this presentation today, I will be able to give you an optimal deposit insurance threshold number. What we're going to tell you today is like another missing piece of that conversation. So let's get started by, to think about a very simple two-period model of endowment allocation. So you're basically thinking about consuming today versus consuming tomorrow. That means you're going to save today. So on the y-axis, you have your expected consumption in period 2. On the x-axis, you have your deposits. And basically, whatever you deposit today, that's going to give you an expected consumption along this line, and under the assumption that there's no default from your savings technology. And the slope is basically the gross return on this technology, which is RD. Now assume that this is actually a risky savings technology, so you would have actually gotten a line which is less steeper, and the slope of this line would have been a function of the gross return which you would have earned in the riskless world, and the default probability. So that will give you the expected consumption in period T along this line. Now you can think about, so like having thought about a riskless and a risky technology of savings, you can think about a technology where you actually have a deposit insurance with threshold delta. Then your expected consumption in period 2 is going to look like this kinked set in the sense that if you deposit any amount until the threshold amount, you will always get the gross return. And after that amount, your line will actually have a convex kink over here, and your slope will be something like this. So basically what would happen is this, like in an unconstrained world or in the first best world, you would have wanted to be in this higher indifference curve, but that indifference curve is no longer in your set to basically take on, so you can't really deposit D star. Instead, you land up basically just being at this point where you are actually having to deposit all this at the deposit insurance threshold. Now, what this implication is that if you assume like a smooth density of endowment of individuals, something like a Pareto distribution, then this is what would have distribution look like if the savings technology was completely riskless. Now, what would happen is that you would actually have a bunching mass at the deposit insurance threshold, and all these individuals who would have chosen to actually deposit a higher amount are actually going to deposit a lower amount instead. So you can see the same thing also in the E sigma space. So this is a very simple diagram that we show in our investment 101 class to our MBA students. So this is the E sigma space, and this is the capital allocation line. W equal to 1 means all your assets or endowments are in the risky or market portfolio, and W equal to 0 means everything is in the riskless asset. Now, what happens is like when you have this deposit insurance threshold and there is so this basically creates a kink in this capital allocation line. As a result, while a mean variance investor would have chosen to basically take on this point, basically operating at omega pi, she actually lands up operating at a lower indifference curve, which is just touching this particular point, which is the bunching point. As a result, what happens is like when you have a deposit insurance So as a result, what happens is like when you have a deposit insurance threshold increase, this line basically moves towards your left, and as a result, you can operate on a higher indifference curve. So a very intuitive and very direct implication is that if deposit insurance threshold moves, basically then deposits increase and the investment that you have in the risky assets is going to decline, and the strongest effect you're going to observe is basically for the bunches. In the paper, we also have an extension. Okay, I'm going to jump directly to the institutional details now. So, a very fun fact, actually, India was the second country in the world to institute deposit insurance. The first country was actually US. That means when India was making its charter for DICGC, which is basically the Indian version of the FDIC, the only benchmark they had to follow was the FDIC. So if you look at the charter of DICGC's institution, it exactly follows the rules of deposit insurance allocation, taking premium, how exactly deposits are paid out, exactly like FDIC. So this makes my life easier because usually I have to spend a lot of time explaining a lot of institutional details about India, but if you're aware about FDIC, all those same rules apply to DICGC. And the deposit insurance threshold, this was basically established in 1962, and there was a lot of changes to the deposit insurance threshold until early 90s, and after that it almost became stagnant until basically February 2020, which is just before COVID, that the Indian government basically decided to increase the deposit insurance threshold from like 100,000 rupees, which is almost $1,400, to around 5 times, which is like 500 rupees, which is like around $7,000. What was the key reason to do that? So because India had not changed its deposit insurance threshold for a very long time until the 1990s, the deposit insurance to per capita income ratio was around 0.71. And India is also part of BRICS countries, so it always has this club convergence agenda of trying to match its key ratios across all its other countries. So for example, when this change was being made, similar ratios for Brazil and China were of the order of magnitude of around 7. So India also wanted to increase its deposit insurance threshold to be more comparable with its peers in the BRICS countries. So that was one of the key reasons why this deposit insurance threshold was increased at that time, and the actual change was implemented in February of 2020. Also, just giving you like a primer on like are bank failures often or rare in India. So DICGC has actually given out or actually settled claims on deposits associated with like around 27 failed commercial banks. So these are like large banks, as well as like around 357 cooperative banks, so think of them as like small banks. So just to show you like the timeline of how exactly the failures happened. So you can see like a lot of these failures happened during the 2008 crisis, but India has had like a nice journey of its own with bank failures. And this is not just associated with like small banks. So this is like a news headline about one of the largest banks in India, or one of the largest private sector banks in India, the ICICI Bank. During 2008 crisis, there was an immense run on the deposit by the depositors, both large depositors as well as several small depositors. So bank failures are not really very rare in India. They do happen, and depositors do seem to be very cognizant of these bank failures. Let me quickly talk about the data that I'm going to be using in this paper. So we're going to start with using this very granular and detailed depositor level data from a large private sector bank in India. And the data will basically comprise of like 4% random sample of all the retail customers, conditional on the customer having at least one of the different types of deposit account. So as per DICGC, to have deposit insurance, you can have 3 kinds of deposit accounts. One is the savings account. You can think of them as like your regular checking account, but they do earn interest rate. The second one is the current account, which is usually held by corporates, so not really held by individuals or retail depositors. The other one is time deposits, which is very, very similar to the time deposits in the US. The other one is a recurring deposit, in which you promise to bank that you're going to deposit X amount of money every month until the maturity of that particular instrument. So almost think of it as like an opposite of annuity, where you actually give the money to get a lump sum payment in the end. So these are the 3 kinds of deposits, basically savings deposits, fixed deposits, which are basically time deposits in India, and recurring deposit, which is this instrument. We can also observe their detailed transaction details, like how much amount they are transacting, at what time the transaction is happening, and the mode, like are they doing the transaction via ATM, or is it like via debit card. We can also see any loans that these individuals have. We can also observe their credit score from the credit bureau, if at all they have taken out any loans in the past. We can observe the demographics, the age, gender, location. We also have access to imputed income and the profession of these individuals. And lastly, most importantly, we can observe ISIN level information on the stocks and the mutual funds that these depositors are holding on a daily basis. So any transaction that do, we have a record of that. And then we can also observe this investment in illiquid but riskless asset called public provident fund that I'm going to talk about a bit fleetingly in the presentation. So just to talk about the aggregate effect, on the aggregate, as soon as what happens, so like you can look at the median deposit, the bank level deposit, and the average deposit based on only on our sample. In the paper, we also show the aggregate data, but over here, I'm just showing you what happened to our bank deposits. So you can see, like after the announcement, bank deposits basically increased. But of course, this is not really well identified. So what we're going to start with is like looking at the depositor distribution of how exactly depositors are distributed along these thresholds. So this is the key picture that we observe. So 0 point over here is basically the point of the old deposit insurance threshold, which is the 100,000 rupees. And what you see is that there's a large mass of depositors here at this particular threshold. And what happens is like when this particular policy is announced, that is this deposit insurance threshold becomes insignificant, the bunching mass over here reduces substantially. You still see some kink over here. That is because 100,000 is a round number, and we do observe some round number bunching. So this difference in difference estimate, which is the difference between these two, allows us to look at what is the mass which actually got displaced. And so what we're going to do in our empirical strategy is we're going to compare these bunches, which we're going to loosely call as treatment, and then we're going to compare them to the non-bunches, at people who are just above the threshold, to basically see how exactly they are responding vis-a-vis the bunches. And of course, bunches are systematically different individuals than non-bunches. They are people who are strategically choosing to be at that particular point. So we're going to basically saturate our specification with a lot of fixed effects. Specifically, we're going to use depositor fixed effects. We're going to think of this estimator as a within depositor estimator, as in like on average, how does each depositor respond? And then we're going to include the zip time months fixed effect. This is going to basically help us control for a lot of local and aggregate level shocks, especially when you're thinking about a lot of the post period was a COVID-related period. And a lot of this COVID effect were like very, very local in the sense like the deaths and other things were very local. This is going to actually help us abstract away from that. And our key assumption is going to be the parallel trends assumption. So I'm going to just get started directly with the results, which is basically over here, I'm trying to look at what happens to the response of depositors who were bunching relative to the non-bunches. And what we see over here is that that there were no pre-trends before this particular announcement. As bunches and non-bunches were almost moving very similar fashion to each other. And after the deposit insurance threshold was increased, the bunches increased their deposits by around 5% on average. And if you look at like 10 months after the announcement, the deposit increase basically kind of saturates at like around 12%. Now, what you can also do is basically compare bunches with very, very different kinds of non-bunches. So you can start by comparing them with bunches which were between 100 and 200. You can also compare them with bunches which were between 200 and 300. You can also compare them with bunches between 300 and 400. And you see that that systematic response occurs, which is basically the key point of our model, in the sense that bunches actually exhibit the strongest response to this deposit insurance threshold increase. And just to put these numbers in the context of elasticity, what we are trying to say is that 1 percentage point increase in deposit insurance coverage is associated with like 2.1 to 3 percentage point increase in deposits. If you look at the estimates based in US, this number is like around 3.4. Number from Colombia is like around 2.3. This number in US, 3.4, is coming from the increase that happened during 2008 from 100,000 to 250,000. So what are the portfolios? So like we can start by comparing. Now we can take a step back from the deposit response and try to think about how exactly do bunches differ from non-bunches. So you can think of them like a t-test. You can compare them on like several characteristics such as their age, gender, etc., as well as you can compare them on their portfolio, which is basically looking at their banked wealth, stocks, or how much amount of the banked wealth are they putting in the stocks, mutual funds, and so on and so forth. And what we see is that actually bunches are quite similar to non-bunches on the context of demographics, but they're not really similar in terms of their portfolio composition. Specifically, if you look at like all these demographics, such as their age, gender, marital status, whether they are the household head or not, how many family members do they have in their family, how longer they have had a relationship, what is their imputed income. You can look at a lot of their banking variables, such as do they have a credit score, conditional on a score, what is their score. We don't really see much difference or like a robust difference between bunchers and non-bunchers. But when we look at their banked wealth, it seems bunchers have lower banked wealth than non-bunchers, which is kind of mechanical here because we're comparing bunchers who are just below 100,000 to people who are above. So that is kind of mechanical. But once you control for that, what you see is that the share of stocks that they have in their portfolio is higher. The share of mutual funds that they have in their portfolio is also higher. And the share that they have in this illiquid but riskless technology known as the PPF is also higher. So this is again very consistent with the model that we were saying, that before the threshold increase, these individuals were stuck with this deposit insurance threshold, and as a result had lower amount in their deposits and a greater proportion of their wealth in stocks, mutual funds, and other alternatives such as long-term illiquid but riskless assets. So to actually provide more evidence on like how exactly these individuals were responding, we merged this data, which has this depositor level information, with the detailed information into like whether they are trading or not. So this is going to be a very binary variable, and I'm going to go into like more details. So what we're going to do is basically compare people who, so like within bunches, we're going to compare traders and non-traders. And what we see is that majority of the response that you saw from bunches was actually driven by these individuals who were traders. And if you look at non-traders, they don't really respond to deposit insurance threshold. But of course, like traders is a binary variable. It could be correlated with a lot of sophisticatedness. So what we're going to do is basically harness the rich information that we have, which is on the ISIN level information about their stock holdings. But key objection or the key empirical issue in just comparing directly the stock holding is that bunches are special individuals. So they can have non-random matching between their portfolio or individual securities that they're holding and themselves. So this is like a key problem in identification. So what we're going to instead do is we're going to include ISIN cross month fixed effect. So this basically allows us to abstract away from this non-random matching. And I'm going to come back to the non-random matching in a bit. But this allows us to basically go away from this non-random matching and try to see the response of the buncher and the non-buncher for the same stock within the same month. So this not only allows us to control for non-random matching, but also allows to control for any fundamental shocks that are happening at the security level. And what we see is that bunchers actually reduce their share, the number of stocks that they're holding, and the amount in both senses. And what we can do is that we can actually do a back-of-envelope calculation by looking at these numbers. And we can say that actually 72% increase that was coming in the deposits that we were observing can actually be explained by this particular liquidation. So what I've told you so far is that bunchers kind of seem to have this unmet demand for safe assets, and then they tend to invest more in the illiquid safe asset, which is PPF, or in the liquid risky assets, which is stocks and mutual funds. But now I'm going to go back, and in the last slide, I basically abstracted away from the non-random matching. But now let's actually think about the random matching. So if they actually have an unmet demand for safe assets, they should be looking for safety even within that portfolio. So what we do is for each individual, based on the characteristics, we compute portfolio tilt based on this methodology in John Campbell and Tarun's paper. And what we see, so in the paper, we talk about a lot of characteristics. The one that I'm showing you today over here is investment in state-owned enterprises. So state-owned enterprises tend to be considered more safer options in most emerging economies. So what we see is that actually if we look at the coefficient on bunchers before the deposit insurance threshold, they had an over tilt of their portfolio towards the state-owned assets or the state-owned enterprises. And after this deposit insurance threshold was increased, they basically liquidate a part of it. And actually, if you do a t-test of combining them, this actually is statistically indistinguishable from zero, indicating that they almost undid their entire portfolio tilt. And then finally, we also observe that there is actually a temporary price implication of this kind of liquidation by bunchers in the stock market, in the sense that if you look at the state-owned enterprises stocks, they actually fell. But of course, there was a reversal of these stocks. So next, I'm going to go back to the wealth analysis, so the model that I spoke about with you earlier in a very, very, very descriptive way. So what is the key point in the model is that if you assume a smooth distribution of individuals, so in this case, we assume a Pareto distribution, so there are individuals who are extremely poor. They're extremely uninformative to us because they don't really have enough endowment or enough wealth with them for deposit insurance to matter at all. Then there are ultra-rich people. Of course, these ultra-rich people take into account this deposit insurance threshold and probability of bank failure while making their portfolio allocation choices. So while it is informative, it seems to be somewhat noisy. What is really the key over here is this middle segment of the endowment. In the sense that if you look at this interval, this lower bound is not really a function of pi. So pi over here is the probability of bank failure. Rho you can think of this as the risk premium. Delta is your deposit insurance threshold. Gamma is the risk aversion, and sigma m square is the volatility of the market. So this interval actually increases in pi, in the sense that you can actually invert this under the assumption of smoothness of the distribution and say that actually share of bunches become a sufficient statistic to compute the depositor implied probability of bank failure. So this we think of as another contribution of this paper, because now, so far, we have only had equity-based probabilities of bank failure or CDS-based probabilities of bank failure. What we can give you actually, just by asking a regulator one number, which is share of bunches in each bank, and if regulators are like pretty informed about what is the risk aversion they assume for their individuals in their economy, they can actually come up with what is the pi or the probability or depositor implied probability of bank failure for each individual. So in our setup, we compute that this pi, depending on risk aversion value, ranges between 0.2 to 1.7%. Just for benchmark, if you look at the 5-year probability of bank failure based on equity data, this is around like 7% for private banks and around 20% for state-owned banks. You can also look at the distribution of this welfare in the sense a majority of these welfare gains is coming from people who are in the middle endowment range. That is, they are the people who are doing active portfolio reallocation and are coming on a higher indifference curve. And of course, there are also these super ultra wealthy people, and the majority of the gain for their welfare is coming from the fact that a part of their assets which was uninsured now becomes insured and safer. So as a mean variance investor, they become more happier. So on aggregate, you can see that the welfare range is basically around 0.05 to 0.4%. And of course, because these are mean variance investors, the welfares don't really have much of a meaning in the sense that they're not consumption equivalents. So what we do is like a counterfactual exercise where we try to convert, so like how much of this welfare gain would correspond to like, so like if in the old DI regime, if I had to give them an extra expected return, how much expected return I would have to give them to basically be equal to the new utility. And we find that this is approximately equal to around like 0.12 to around 0.91 percentage point, which is a decent increase. We can also think about the moral hazard in this case, in the sense that what we're assuming is that deposit insurance increases and the probability of bank failure almost remains the same. Alternatively, you can think about setup or a counterfactual where actually, just like Calomiris and Khan would argue, or a lot of works by Charlie would argue that when deposit insurance increases, banks become more risky, so perhaps the probability of bank failure increases. So this line would actually become less steeper, and that would basically imply how much moral hazard is there. So in the paper, we do a bunch of counterfactuals where we actually allow the probability of bank failure to basically fail to basically to a very large number. So like we allow it to be 0, which is a benchmark case, which is like no moral hazard, and around increasing of like 15%, which is like one of the extreme cases what we learn from the literature. And what we see is that the welfare gains are still positive. Of course, they're more muted. And they're actually more muted for these high wealth individuals, and that is because a part of their portfolio becomes now much more riskier than it was before in the old DI regime, and that is what is leading to a lot of these welfare losses. In the interest of time, I'm not going to go over external validity, but I do want to talk a bit brief about one caveat of this analysis. So one obvious way in which depositors can undo this limitation is basically by opening accounts with multiple banks. Now, I really tried to work around and so in the paper we do a bunch of robustness tests. For example, we look at depositors who are basically located in zip codes or areas where only bank branch is the bank branch of our bank. And again, we find our results are robust. which indicates that there might be some geographic, so that test tells us that our results would hold under the assumption that there are some geographic frictions in being able to do that. But regardless of that, I think there's also large conjectures in the literature trying to say that actually depositors do not really hold multiple bank accounts. And why is that the case? I think we don't know as a literature, and I feel like that's something that I do want to work on in my future work. But I would really love to hear your comments on that. One test that we do over here is basically look at, so our results remain robust even when we focus on zip codes that are in those zip codes where our bank is the only bank. We also look at spending, or like if the spending changes materially. It does not. So lastly, to conclude, what our paper really talks about is giving you a relationship between deposit insurance threshold and portfolio allocation. We bring in new data to the table and combine it with the model to show how exactly depositor bunch around the deposit insurance threshold and how that movement can be informative to compute depositor implied probability of bank failure and can have temporary asset pricing implication. Thank you so much, and I look forward to your feedback.